We're going to go into the second last lecture of the Micro Business Startup Program, lecture number 31, and it is funding your business. And really, it is what loan institutions look for when you apply for a loan. Now, I need to say two things that are very, very, very important before going into this lecture. And the first thing that I need to say is when we go through this lecture, it is based 90% on the rules and regulations for funding as set out by the Reserve Bank of South Africa. So the Reserve Bank, which is our top bank, so this is not a transactional bank. What we mean by that is you can't put your money into the Reserve Bank and draw it out. So it would be equivalent in America to the Fed, the federal bank. So it is the body that is that regulates the loan environment in countries. So in Zambia and in Rwanda, you would definitely have something like the Federal Bank or the Reserve Bank or something like that, which is your top institution that makes sure that the financial situation or the financial or the economic development or the economic activity within your country is not only regulated, but they do things like regulate your currency, regulate the macro economy, and set interest rates and this type of thing. So that is the main bank that does that. And as I've said, they control all of the activities in the financial sector. So that in South Africa is the Reserve Bank. And so when I go into this lecture, I'm giving you a lot of rules, and not a lot of rules and regulations, but regulations that have been set down by the Reserve Bank. Okay, so that's the first thing. So I hope that the lecture is going to be relevant totally to you guys in Zambia, as well as to you guys in Rwanda. But you may need to check with your equivalent of the Reserve Bank what the rules are in Zambia and in Rwanda, because it's from these that it's from the equivalent of the Reserve Bank that the other banks set their interest rates, set their policy for loans, and this type of thing. So it would be very important for you to check it out. The second thing that I want to say, which maybe I should have started with this because it's actually the most important, is our stance in terms of, and our position in terms of the Dynamic Business Startup Partners is try where possible not to go for a loan. And the reason I say that is because the moment you go for a loan, the moment you borrow money, you've got to repay it. There is no such thing as not repaying it. And if you don't repay it, there are some serious repercussions. A repercussion is something that happens to you if you don't repay a loan. And particularly if you borrowed money from the banks, they are to a large extent uncaring about you as an individual. They are caring about your ability to pay back the loan. And if you default, They have got no, what's the word? Interest. They're not interested in your excuses. They're not interested in your financial situation. They're not interested in anything else but getting their money back. And they will confiscate property. They will confiscate stuff in your business. They will close you down if you do not repay them. And so as soon as you go for a loan, listen very carefully, as soon as you go for a loan, you become a prisoner of that institution. You sell yourself into slavery. So this is why I say a loan can bring life, but it can also cause a business to have to close down. So try where possible to be self-funding. Now, what does self-funding mean? It means that you would either have your own money, or it means that you borrow money from friends and family, or get them involved in the business as investors or something like this. Because if you do that, you are not, you could always negotiate a little bit with friends and family. You can't negotiate with a bank. So you put yourself, you become a slave to the bank or the financial institution that's loaned you the money. And you wouldn't have to, if you default, you'd have to negotiate with them. And sometimes they are not negotiable. Now, I can say this, why do most people borrow money? A lot of people, particularly in South Africa, and I must say this, South Africa is one of the most, what we call, over-indebted countries in the world. Now, what does over-indebted mean? Over-indebted means that you are owing so much money that you struggle to pay it back. And one of the most growing industries in South Africa is, there are two of them, debt collectors who go around collecting the debt, and the organizations that help you with negotiating on your behalf with those that you owe money to, which is called your creditors. So they are, it's a very, very big growing business, debt restructuring, and companies that help you to do that. Okay. Now, just to put this lecture into its context, we did two lectures before this, the lecture on communication and the lecture on negotiation. And negotiation, of course, involves communication and the ability to communicate well. So if you haven't listened to those lectures yet, I strongly urge you to do that, because if you are borrowing money, you will have to negotiate certain things, and you can't negotiate if you can't communicate. And watch the communication lecture, and then later on today, I will find a previous copy of the negotiation lecture and put it up. All right, now, okay, Ellie, you've raised your hand. Please, you can unmute and ask your question.
Yes, my question is, can you negotiate with the bank when you're looking for a loan?
Just say that first part again, Ellie. Can you something the bank?
Can you negotiate with the bank when you're looking for for the loan?
To a certain degree, yes, you can, Eddie. To a certain degree, you can, because you can actually negotiate interest rates. Sometimes you can negotiate the term of the loan and these type of things. Now, if a bank is, banks are there are, I don't know how many banks there are in Rwanda. These are the main banks, but in South Africa, there's 5 of them. So there's 5 main banks. Now they all are looking for clients, and so they and some of the banks offer very good business services where they can certainly help you and your business. I know that one of our banks, Nedbank, has launched a unit which looks into manufacturing. So if you're a manufacturing business, what Nedbank is saying is, we want your business and we have technical expertise to help you in terms of setting up a manufacturing business. So, the banks in your country are also likely to provide some kind of support and help. And because if they don't, the defaults on the loan, what a default on a loan is when a loan, when the people struggle to pay the loan back. So it's called a defaulting loan. And a lot of the banks are wanting to prevent that, particularly in these day and ages. Now, what do I mean by that? The economy of the world is busy falling, busy going down, which means that life becomes harder and harder for your average citizen. Now, this is where the banks are, they're starting to get a lot of people that are starting to default on their loans, and they would much rather negotiate terms with you than have you not pay the loan, because then it's going to hurt the bank and certainly it's going to hurt you. So that's why I say in most instances, or some instances, let me rather say, the banks are negotiable. Now, if you run into trouble, if you've got a loan with a bank and you run into trouble, the very, 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 very worst thing you can do, the very worst thing you can do is run away. The very worst thing you can do is ignore their attempts at communication, because then you are only inviting disaster on yourself. So if you've got a loan and you can't repay it, please seek help. Now, as I said, in South Africa, there's a growing industry called debt counselors and the debt counseling profession, and they help you to try to overcome problems with when you've got a lot of people that you owe money to. They step in and help you out. It's too complicated a process for me to explain as we go through this lecture, but it is certainly something that if you are struggling with a lot of debt, you might just want to look into in your country whether there is such a thing called a debt counselor. Good. Now, I want to, before I move on with this lecture, I want to just say to you all that I have had quite a lot of experience in dealing with loans. And the reason for that is I'm part of something called a cooperative financial institution here in South Africa. So you've got, just to tell you what that is, in South Africa, you've got 3 levels of bank. You've got your big, well-established banks, and those are called level 1 banks. Now, for the South African people, what would fit into level 1? It would be Absa, Standard Bank, First National Bank, Nedbank, Capitec. I think an African bank as well. So those are the 6 ones that would fall into that category. Then there are a lot of others that are coming up, like Discovery Bank and that type of thing. Now, that's the first level bank. The second level banks are what we call mutual banks. So you've got things like Old Mutual. You've heard about that in South Africa. And so that is a mutual bank. Remember, South Africa had a big scandal a couple of years ago called VBS Bank. Now, VBS Bank was a mutual bank, and it's why I say it's a big scandal for those that don't know, who are out of South Africa, in Zambia and in Rwanda. There was a lot of fraud that was committed there, and that bank ceases to exist at the present moment. So that's a second level bank. That's your mutual bank. And then the third level is called your CFI, your cooperative financial institution. In other countries, it's called a credit union. So if you are familiar with a credit union, it's exactly the same as a cooperative financial institution, or a CFI, in South Africa. Now, I'm part of a CFI called the GIG CFI. GIG stands for Generational Inheritance Group. And basically, it is a Christian-based organization that is, for want of a better word, quite a large loans and savings club, where it's a membership-based organization where we encourage our members to save money and to become good. Now, good is an acronym, GOOD, which stands for Get Out of Debt. Get out of debt and put your money to work by getting assets. So that is what we are involved in. Now, I used to be part of the board of the CFI. I am now part of what's called the audit committee that checks up that the board is doing their job properly. And then I was also spent about 4 or 5 years on the credit committee. Now, the credit committee was involved in making sure that when people borrowed money, they were, or when the CFI loaned people money, let me rather say, that they qualified for the loan. And so I'm going to speak to you about the 5 C's of credit in about 2 slides time, and then we will address that. Okay, so unfortunately not, Ellie, we can't, you can't become a member of our CFI if you're not in South Africa. Sorry about that, because he writes, can you lend someone who is not a Southern African? So the CFI can't do that. Okay, now, unless you are living in South Africa. Okay, so a loan can help a business grow by providing money to start up the business. In other words, for setup costs, so that you can have money to buy your initial stock, so you can have money for working capital, and money to expand your business. Now, remember what working capital is. I'll just draw a little thing just so that you are aware of working capital. Remember this graph, and remember, so this was here, this was time in months, okay, and this here was in money, okay, money in terms of sales. Now, this was time in months, 1 month, 2 months, 3 months, 4 months, 5 months. And what we said is that when you start a business, it's the amount of sales that you make are often start out small, and they tend to grow over time. Okay, but now you've all learned about break-even point. So say that your break-even point was this pink line that I'm going to draw. And that's your break-even point where you need to have this amount of money every month. So there is a shortfall between the amount of money that you can bring in from your sales, and that's this arrow that I'm going to draw here. So that's the amount of money that you bring in from your sales versus the amount of money that you are short of every month, which is this pink line that I'm going to draw here. Okay, so basically your working capital is the amount of money that you need to have, and I will draw it in red. The amount of money that you need to have, this amount here, okay, this amount here that I'm shading in red, okay, that you need to have available so that you can keep your business going. So you would be able to work out what your working capital is. Okay, so that was working capital, just to refresh you. And so loan can help you with that working capital. Okay, now that's how a loan can help your business. And if you want to expand your business and you want to grow the business, that can also be, that's where a loan could be fantastic. But a loan can hurt your business. Why? Because you have to repay it every month. And the loan institutions are not interested in how well and how bad you did for that month. So if you had a terrible month and you can't repay the loan, they're going to say, it's not my problem. It's your problem. I need my repayment. Whatever you've agreed to repay, I need that. So in other words, a loan can actually sink your business because, you know, if you are needing to repay it and you don't have the sales to cover those repayments, then you have to find the money somewhere. And often what happens is you take the money from your working capital, or at least you take the money from from your variable cost money, the money that you've got to buy products. And so therefore it sinks your business. Remember the whole thing of our conversation about feast and famine principle. Okay, so that can sink your business. It can also mess up your cash flow by you having to repay money that you had set aside to do something else with. And so it messes up your cash flow. And then, of course, you are paying interest because so many people are, so many every institution that loans money requires you to pay interest. And so you'd need to pay off the interest. And often what happens is with loan institutions is you pay off your interest first, and then you start paying off the capital. So and I'll just give you a couple of hints when we get down to that point about that. But so it can put you in chains, so to speak, and you become a slave to the lender. The scripture actually talks about, the Bible actually talks about the borrower is a slave of the lender. That's in Proverbs somewhere. Go and look it up. But you do actually end
arrived at work safely.
wanting people to mute. Okay, all right. So what can you use a loan for, and what can you not use a loan for? So you cannot use a loan or part of a loan to pay off other debts or other loans. It's very, very dangerous to take on credit. In other words, you take on a loan to pay off another loan. There's only one institution and one time when you can do that, and that is with GIG, the Generational Inheritance Group, CFI, because we are able to, once you've saved money, we are able to loan you money at almost no interest at all, So the whole idea is to get out of debt is you use that money to pay off the debts where you owe a lot of interest. So don't take out a loan to pay off another loan, because often you are just swapping the interest you're paying for one loan with the interest you're paying on another. And it only will make sense if the interest rate that you're paying on the second loan is lower than the interest rate you're paying on the first loan. Okay, so that's the only time it would make sense. You should not be borrowing money to clothe yourselves or to clothe your family. Now, the clothing industry and the food industry in some senses, but generally the luxury industry. Okay, so it's the luxury industry and the clothes industry love getting you into debt. So they send you this card and they say you can have so much on credit. In other words, you can buy the clothes on credit and you have to pay later. And be very careful, because you know, one often thinks, oh, I've got 500 Rand. Oh, I've got 1,000 Rand. Oh, I've got 1,500 Rand on my card to buy clothing. And you go and buy that clothing recklessly. Not that you don't need the clothing. You may need the clothing, but you've got to pay it back. And so let's say an item of clothing on the shelves is marked at, let's say, 150 Rand. Okay. Now, when you work it out, when you've paid off the interest on that free card, that item of clothing will cost you more than 200 Rand at the end of the day. So in other words, although they are offering you special deals to buy clothing on all of these types of cards that they've got, Edgar's cards and Clicks cards and Pep cards and all of these things, it is not free. It is not free money. You are paying interest. So don't use a loan to clothe yourself. Certainly don't use a loan to have pleasurable things like parties, drink, entertainment, these type of things, because you will be paying much more for what you buy. Don't use a loan for gifts or presents. Don't use a loan for travel or transport unless it is directly related to getting your products so that you can sell your products. Do not use a loan to buy things on special that are not directly related to your business and for what you needed the original money for. So often you go into the supermarket or the wholesaler to buy things and they got something on special. You think, oh, let me just use my credit card quickly and I can buy that thing really, because it's on a good deal. It's a good special. And, you know, this whole thing that we've just had of Black Fridays, be very careful of that, because they want you to spend money on credit. So often it's done through credit cards, and credit cards is a way of loaning money, but the interest rates on a credit card are very high. So just be very, very, very careful about credit cards and buying on credit cards and this type of thing. And you should not use a loan unless it's a personal loan to cover emergencies in your own life, that of your family or your loved ones. So never use business money to cover personal emergencies. Now, you should have all learned by now that you need to be paying yourselves a salary. And it's money from that salary that you should use to pay off your own emergency. Okay. Now, listen carefully. You and you alone are responsible to pay off your loan. You cannot expect another person to pay off a loan for you, even if you're part of a group of people or part of a project or part of a something in this country which we call a stokvel. Now, stokvel is where you get a group of people together. Now, for a simple reason, let's say 12, and you save amount of money every month. And then every month it is the turn of another person to get that pot of money. So let's say there are 12 people in a stokvel and each is saving 100 Rand. Okay, so that's every month 1,200, 12 times 100 is going to be saved, and every month a different person gets that money. And you don't actually have to pay it back. It is not a loan, it is a stokvel. And those are quite good to get involved in. So you might want to get involved in one of those or set one up. Now, what I do want to say, and this is now, I want you to pay very, very close attention to what I'm about to say now. Often, when somebody wants to loan money, the banks ask for someone else to stand surety, okay, or to sign surety. Okay. Don't do it. If somebody asks you, a friend, family member, or anybody else asks you, please stand surety for me so that the bank will loan me the money to buy whatever, to buy my new car or to buy my house or to buy whatever the case may be. Now, what is surety? Surety is basically saying if that person doesn't pay, the bank can come after the surety. So let's say that they owe, let's say 12,000 and they can't pay. The bank looks at the paperwork and they say, okay. So Ellie is standing surety for Vincent. Okay. Ellie, you are owed Vincent's debt. And so that they can come after you because you signed a surety document. And in other countries, it's called a pledge or some other term which covers the debt of another person if they cannot repay. Don't do it because the banks can come after you if the original person doesn't pay. Okay, any questions or comments around that before we move on? Now, there are 3 different types of loans. There's a short-term loan, a medium-term loan, and a long-term loan. Now, let's unpack all 3 of these. A short-term loan is generally under 12 months. 12 months and less is a short-term loan. So if you are going to pay off something within 12 months, it's called a short-term loan. And it's generally financed by a bank overdraft or a credit card or suppliers with credit with your suppliers. And by the way, that's the only form of credit that we would actually say is very good suppliers credit. When you buy something from the supplier and you have to pay at a later stage, arrange that if you can, because it's good for your cash flow. It means that you can be in positive cash flow. Or some kind of a term loan where you have to pay a certain amount a month, but you have 12 monthly repayments. So that's a short-term loan. And what do you use a short-term loan for? You use it for stock, or you use it to buy a couple of pieces of equipment, or you use it to expand your business in some way. So just remember, short-term, paid not less than from 1 month up to 12 months, a short-term loan. Medium-term loans are loans from the 13th month up to 60 months, which is 5 years. So that's called a medium-term loan. Okay. And generally, these are some terms that are referred to in the medium loan: term loans, installment sales, lease agreements, or rent to own. Okay, these are medium term loans. And what do you use a medium term loan for? In South Africa, it's the most common way of using a medium term loan is to buy a motor vehicle. Okay, so motor vehicles, generally, you would need to pay back a motor vehicle in 60 months, which is 5 years. Okay, so some other more expensive types of equipment that cannot be paid off in 12 months for your business, those are medium-term loans. So short-term loans generally for stock, medium-term loans for quite expensive equipment and cars, and then you get a long-term loan. Now, a long-term loan is from 6 years right up to about 30 years. Now, generally, long-term loans are for land, buildings, or things, maybe equipment that is very expensive, so that where your repayments are longer than 5 years. So that would be a long-term loan. Okay. And generally it's financed by mortgages, or in this country we call it bonds. Okay. Now, listen up and listen very, very, very carefully. With a long-term loan, so generally in South Africa, you've got, for long-term loans, you are given up to 20 or 30 years to repay. Now, remember that all loans above 12 months are subject to what we call compound interest. Now, what is compound interest? What compound interest is interest on interest. I'll say that again. Compound interest is interest upon interest. Now, what we're saying is, if you are owed, so let me just draw something just so that you are, I can explain it to you in picture form. Okay, so let us say that this block here represents the loan. Okay, so this is the loan amount. Okay, now on the loan amount, you have got interest. Okay, now let me change the color to blue. So on this loan amount, you've got interest that needs to get paid, right? Okay, so there's your interest portion that needs to get paid. So let me just label it interest. Now, if this period here, okay, this period here of repaying, okay, if this period here is longer than 12 months, okay, then they're going to take this interest portion and they are going to add to it the interest on the interest. And for the second year, interest on the interest. And for the third year, interest on the interest. So in actual fact, you don't end up paying for red and blue, you end up paying for red, blue, and green. Okay, because this here is interest upon outstanding interest. Okay, so if in the first year, now I should actually draw this the other way around. So let me just quickly draw this the other way around. Okay, just so that you understand. Okay, so let me take, sorry, again. hope this is going to work. Oh, it's not. Okay, it doesn't matter. So what normally happens is, okay, is you pay off your interest first. So let's say in the first 12 months, okay, let's say you are able to pay off this amount of interest that I'm going to draw in yellow. Okay, so let's say that you've been able to pay off that amount of interest. Then the rest of the interest here is compounded. So what happens is this moves out a little bit and you get, you get compound interest sliding in there. Then in the next month, you are able to pay, the next year rather, you are able to pay off that much there, okay? You get the balance, whatever's in blue, gets compounded, okay? So you slide in another one here and that one moves out. So in actual fact, what is happening is that you've got, let me just draw this like this, in black. From this point here, okay, that point there where you borrowed the money to this point here when you've paid it all off, what's happening is because of compound interest, this is sliding there, sliding there, sliding there, sliding there, and this is moving. This is moving there, okay? So what they do is when they work out your bond, okay? So they work out, just let me, oh, I don't think I'm going to be able to, okay, so let me just slide that. Like that, slide like this. So what they generally do is they say, right, this is the money and the interest. Now, if there was no compound interest, you would pay it off in, let's say, 8 years, okay? But then they say, right, we are going to set it at 30 years, okay? Because we know that there is compound interest that's going to be payable on that, okay? So you end up paying double, triple, and 4 times the original amount of money because of the interest portion and the compound interest portion. So here is my advice. Let us say that your repayment, okay, let's say that the banks work out your repayment, and let's say it's 1,000 a month, okay, per month. Okay, now I would suggest you squeeze yourself and pay 1,100 per month. Okay, just adding another 100 will actually, what it will do is it, so say that this period here, just let me put in, say that this period here is 30 months, okay, between this here, that there, and that there. Say that's 30 months, okay. So if you just pay a bit of money extra, you are paying off the interest portion quicker. So what'll happen, sorry, just let me, I need to just try and reduce this. All right, good. All right, so what'll happen is this will end up, come on, shortening the period of time. Therefore, you are saving yourself money. Okay, so just by putting in a little bit extra money every month, you are shortening the amount of money and saving yourself all of this compound interest that I've just colored in black. So for a long-term loan, if they say your repayment rate is 1,000 whatever per month, currency per month, if you pay a little bit more, you are shortening it from 30 months to about 22, 23 months, therefore saving yourself a lot of money. So that's just a little hint. Okay, does anybody want to ask a question about that? Make a comment maybe. Okay, I'm going to clear all the drawings. Okay, so let's move on to something called loan criteria. So what are the three most important things that any institution looks for when judging whether you're a good person to loan money to? So number one, safety. They are concerned with the ability, your ability and willingness to repay. Here, the institution looks at the personal characteristics of the person behind the business, as well as their financial situation, the security, and the business environment in which they operate. Now, I'm going to expand on this after I've done the next slide. The second thing they look at is desirability. How much you want and for what purpose, and how you are going to repay that over the period of time that is set. Okay, so safety, desirability, and profitability. So we're going to look at, if we loan you this money, will the business become profitable? And one of the items that dictates to a bank whether you are going to be profitable is the degree of control required. Okay. All right, we're going to revisit all three of these in a moment. Now, these are the criteria that a loan, so these are the 5 C's of credit. Okay, so any financial or loan institution in South Africa has to conform to something called the National Credit Act, the NCA, as set out by an institution called the National Credit Regulator, the NCR. Now, remember I talked about the Reserve Bank at the beginning of this lecture. The Reserve Bank has set up this organization called the NCR, the National Credit Regulator. And the National Credit Regulator's job is to protect the public from becoming what's called over-indebted. Now, let me describe what over-indebted means. Over-indebted means that you have taken on, so you've borrowed so much money or taken on so much credit that you cannot repay it all. And you are over-indebted if you cannot pay your accounts for 3 months in a row. Then you are considered to be over-indebted. So the regulations that the NCR put in place are called the 5 C's of credit. And these are, remember, if you went back here, we looked at safety and the personal characteristics. So it looks at the first C is character. They need to, all banks and all institutions do a character reference check on everyone to see how much of a risk are you. Now, so they'll go into doing things like looking for a police clearance. In other words, do you have a criminal record? Because if you have a criminal record, if you've been charged with a criminal record, I'm not talking about a speeding fine, right? I'm talking about a criminal record. if they find out that your character is what we call in English dubious. Now, what dubious means is that your character is questionable. They will turn you down. Okay, so that's the first C, your character. The second C is called capacity. And they will say, do you have the capacity to repay the loan? And they're going to look at your financial status. So they are going to ask, if it's not a bank itself, they're going to ask for bank statements, a minimum of 3 months of bank statements to say, do you manage your money well? Then they're going to look for salary slips. So in other words, are you a salaried employee and do you have salary slips to prove it? Now you might say, but we're in our own business. Where do we get salary slips from? You, listen carefully, you as the business owner and your business are two separate entities. I've already explained this to you. Now you go to the business and say, business, I have worked for you for 30 days. Give me my salary. The business should give you a salary and should pay yourself a salary. But also, you need to be issuing yourself with a salary slip. In other words, proof that X amount of money was paid to you for doing that job. And what they're going to look at is A, that they will ask for a minimum of 3 salary slips. Are the 3 salary slips there? And B, are they what we call congruent? Now, what we mean by the word congruent is, was the amount of money paid in month 1 the same amount as paid in month 2 or the same amount that is paid in month 3? In other words, is there stability of income? That's what they're looking for. Okay. Then the third thing that they're going to check is your credit report or your credit score. Now, you've heard the term Big Brother is watching you. Now, believe you me, Big Brother is definitely watching you. What do I mean by that? So it is amazing how much information the authorities have on you. Okay, the authorities of your country have on you. And so much so that when you are asking to borrow money, they go into various institutions in this country. One of them is called XDS. The other one is called IFACTS. And they will ask that organization to do a credit check on you. Now, it's a very simple process because everything in these days is electronic. So they can literally pull up a credit check on you in about 5 minutes. Now, the thing is about these is that they record everything that you do in terms of how good so you've got other debts that you paid off in the past, maybe a clothing account, maybe a car, maybe something else, and they will check on what has your repayment history been? In other words, have you been good at repaying other people's money? And if you're not, then your credit report will come back bad. If you have defaulted and you've been what we call in this country blacklisted, the credit report will tell them that, will tell the institution that, and they will turn you down. So this is a very important piece of checking on people's credit. And if you are blacklisted in this country, in other words, you have not paid off your debt, often what happens is you cannot get further fresh debt because you haven't paid off some of the previous debt. So be very aware that they will check on your capacity. And the third C is collateral. Now, collateral means, what are you putting up to secure your loan? So in GIG, Generational Inheritance Group, you are not allowed to borrow money unless you have saved for 12 months. And then you can only borrow in relation to what you've saved. So in other words, if you've saved 1,000, you can only borrow 2 or maybe 3,000, and the first 1,000 acts as your collateral. So you're putting your own money on the line to say, if I don't repay, you can take the savings that I've got to offset part of the repayment, and that is called collateral. So they will ask you, what security or collateral are you able to put up? So, for instance, if you've got an expensive watch, you can use that as collateral, because then they can sell that asset to pay off your debt if you stop repaying. Or do you have a cell phone which is worth quite a lot of money? Or do you have some family heirloom or something that is of value? So those are the collateral that you can put up. Do you have some gold? Can use this collateral. Do you have an insurance policy that can also be used in certain circumstances as collateral? Okay, it's basically for them to say, what are you bringing to the party? What are you bringing to the negotiation, so that your risk level comes down? That's the risk level of the institution loaning you the money. Then the next C is capital. How much money do you need, and what do you need the money for? So in GIG, we have a look and we see, what do you need the money for? Oh, you need it to grow your business. Okay, good. Oh, you need it because your friend is turning 21 and you need to throw them a big party. No, then they're not going to give you the money. So how much do you need, and what is the money used for? And then the fifth C is conditions. Are there any other conditions that may affect your ability to repay the loan? Anything that would count in your favor or count against you in terms of the loan. So those are the 5 C's of credit. Any questions or comment before we move on? I hope you're finding this interesting. Okay. Now, some other criteria that the bank consider when you ask for a loan is, particularly from a business perspective. So the 5 C's here were generally from a personal perspective. These are now from a business perspective. So they will ask you about the financial structure. Is the company funding its assets properly? In other words, are they using the money that they've borrowed before correctly? Have they put it into assets which can be sold, or are they're wasting it on certain things? So that's the financial structure of the company rather. Then they are going to look at what's called gearing. Now, gearing is the ratio between your own funds and outside funds. So all institutions look to a meaningful contribution by the borrower. So in other words, is there enough money that you are putting up as security for their gearing to be low? So in the Generational Inheritance Group GIG, our gearing is 1 to 3. So the biggest loan that you can get is a 3-to-1 loan, which means that you are borrowing 3 times the amount of what you've saved. So if you have saved 1,000, they will loan you. The maximum gearing is 3,000. So that's called gearing, the ratio between your own funds and outside funds. Then the next thing is the risk involved. How much risk is the institution taking on? In other words, are you a bad risk or a medium risk or a good risk? So that's what they're going to look at, and that is going to be a sense that they get from the documents that you put in. Then the conduct of your bank account. Has your bank account been conducted in such a way as to give them confidence? Or are you missing debit orders and missing other payments and this on a frequent basis? So that's they're going to look at how well do you run your bank account. Then they are going to look at the quality of the security you put up. Now, the two basic questions the banks are going to ask, or the financial institution is going to ask, loan institution, is can the company or the person service at least the interest on the loan? In other words, do they, their monthly repayment, is it going to put them into positive cash flow or negative cash flow? And if they can see it's put into positive cash flow, then you're going to be a low risk, and they're likely to loan you money. And then can the person actually or the company actually repay the loan? Now, remember when we talked about record keeping number 2, we talked about the projected cash flow or your cash flow projection. Remember we talked about that. They are going to want to see that, because this is what they are looking to find out is, can you repay? Is it likely that you, over the 12 months, are you going to repay the interest every month? And are you going to be able to repay the loan? That's why a projected cash flow analysis is very, very important document to have. Then they may call for your cash flow statements, which track your exact repayments, and they could compare the cash flow projection with the cash flow statement to say, hey, you are not a risk anymore. Okay, so that is some of the things that the bank looks for. They'll also look at a low risk profile. They'll look into risk, do a risk analysis. And so they'll look at your management expertise, the financial structure of the business. In other words, has it been properly financed? They will look at your ability to adapt to the economic environment. So they're going to look at the economic environment around you, and they're going to say, is it positive or is it negative? Is in your sector, is it a growing sector? In other words, the economy becoming better and better? Or is it a negative sector where the economy of the area and the environment is in a negative slide? And if it's in a negative slide, they are less likely to borrow you or to loan you money than if it is a positive economic environment. They're going to look at the cash flow of the business, as I've said. And then they're going to look at the underlying value of the assets. Now, remember we talked when we did the balance sheet. They're going to look at your balance sheet because they're going to look at your assets, how much they have been depreciated. Remember we talked about that, and how much money they can get if your company goes under and they need to sell the assets. So that's what they're going to look at when considering giving you a loan. Then as we've heard before, you're going to look at how much money have you put in, a capital contribution of the business owner. And that's put into as security for the loan, but also how much money you've got invested in your own business. So in other words, if you've got zero money or very low money invested in your own business, and you've got many people that you've used to fund your business, then you're going to be at a disadvantage. Then they're going to look at your business plan. How professional is it? How well is it drawn up? And finally, are you requesting too much finances or too little finances? Now, what I'm going to do is I'm going to tell you a quick story, and then we're going to go on our tea break. We're going to pause the lecture, go on our tea break so that we can finish the lecture after tea, because there's still a little bit that still has to be said. So, are you requesting too much finances? I don't need to explain that. In other words, are you requesting too much money for what you are planning to do? So let's say you're wanting to expand your shop and you need 100,000 to do that. They're going to look at what you are going to be putting into the business, into the renovation of your shop, and they're going to say, well, actually, that is, in our estimate, is about 70,000. You asking for 100? No, we're going to turn you down. But too little finances is also a problem. So there's a story of this guy who wanted to start a trucking business, and he needed 1.5 million to buy a truck and a trailer. And he had a very firm contract, and it was completely signed. It was a minimum of a 10-year contract, and the profitability of the contract was great. So he put in, and he had a very good credit score, so there was nothing wrong with him as a person. So he put in for 1.5 million, and although he ticked the box, in other words, everything was agreeable. Yes, 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 yes. They actually turned him down. And he inquired, but why did you turn me down? I mean, I qualified for all of these criteria that you set for me to qualify for. Why did you turn me down? They turned him down because they said, you have asked for too little finances. He said, but why? I did all my homework correctly. I checked that the engine of the truck and the trailer came to 1.5 million. And here's my quotes, and here's the everything that would support that. And they said, yes, but. So this contract of yours, which is a good one, and there's no problem with it, the terms of the contract is that you have to make daily deliveries of whatever it was to the business. And there's a term in the contract which says if you can't make a daily delivery, then it may void the contract. In other words, make the contract not, they may cancel the contract. And they said, the reason that we've turned you down is that you should have asked for money to buy two what's called horses, which is the front end, the motor end of the truck and trailer, the truck part. Because if your truck breaks down, how are you going to pull the trailer to get the goods to from the supplier to the company? You should have asked for 2 million because, or 2.2 million, because then you could have bought two of these trucks or horses and one trailer. So if one breaks down, you've got the other one as a spare, and you could use the other one to get another contract to supply somebody else. So he was asking for too little finances, and they turned him down. So he didn't want to put in. He said, "Oh, 1.5 million. Oh, that's a lot of money. Oh, I better not ask for 2 million because that's too much." And so, you need to understand that sometimes you ask for too little finances because they do their homework. They don't just give out money and say, "Oh, you're a nice guy. You got a nice face. I'll give you the money." They do their homework very thoroughly, and they've got analysts who do the check that everything that you've submitted is indeed true. Okay. All right. Now I'm going to pause here. It's 10:35 for our break. So the next point that I want to go through, just before we do that, Kryfontaine says, "I hope you're good, Chris. I just want to ask you when we are finishing for the year. Okay, so on Thursday, we're finishing for the year, on Thursday. All right. Next point is quality sought in the borrower's management. So what do institutions look for out of you as a manager or an owner of the business? So the first thing they look for is your resourcefulness. In other words, are you able to solve problems? Are you able to think out the box? Are you able to deal with the day-to-day running of your own business? Are there any hiccups in the running of your own business? So that's what they look for. The second is capability. Is the business capable of repaying the loan? Continuity, do you have a good business track record? Do you have successful clients? Are there successful suppliers? Or does the business run well? Does it have a good name? Does it have a good reputation? These type of things is what they look for. And then your own integrity as the owner of the business. The word integrity means, do you have a good name? Do people think highly of you as a person? Or is there some part of your character that people are a little bit, they look at things like your staff. Are your staff happy? Are your staff, has there been many people that have come and gone? Have you fired a lot of people? Because then they're going to start questioning you as a manager and your ability to manage. So as you can see, there's a lot that a financial institution will look for. Okay. Then what is examined in your financial statements? So if you're not keeping records and you want to go to an institution, a recognized institution for a loan, and you don't have financial records, you can forget it. There is no ways they are going to consider you. So what is examined in your financial statements? Again, gearing comes up. How much money have you put in? Then they're going to look at what's called your liquidity. So they're going to look at, has all your capital been tied up, or is there a bank account somewhere with some money or some assets that you could sell quickly to turn into cash to if you get into a sticky situation? In other words, a negative cash flow situation. So they're going to look at how liquid the business can become. Now, what they mean by liquid, as I've said, is can you get a hold of cash quickly? And that is another reason why you need to be saving the profits of your business and not recklessly spending them. Then they're going to look at profitability. Is the business profitable, and is there a consistency to this? In other words, are you showing profit month after month after month after month? Or is there some losses? Profit, loss, profit, loss, profit, loss. If you like that, they're not going to turn you, they're not going to give you the okay and loan you the money. The next one they're going to look at is efficiency of asset management. In other words, are you managing your assets in the business? Are you utilizing them properly? Are you using them to their best ability? And again, cash flow. Does the business remain in positive cash flow most of the time? So that's what they're going to look at in your financial statements. Efficiency of asset management is looking at your balance sheet. Profitability is looking at your income statement. So income statement, balance sheet, cash flow, and analysis. Those are the last three documents that they're going to look at, okay, or the documents related to the last. Then the business environment. They're going to look at the business environment. They're going to take a look and say, how many competitors are in the area, and how strong are you against the competitors? In other words, are you a weak little business with many competitors, or are there many competitors, but you're a very strong business? Are you able to beat your competitors? That's what they're looking at. Because, of course, if your competitors are too strong, they're saying, well, hold on, they could take business away from you, which means that our money is, or your possibility of repaying the money is very much lower. Okay. How reliable are your suppliers? Are your suppliers reliable? Do you have good suppliers? Do you have alternative suppliers? These type of things. Then they're going to look at the government and legal authority regulations. In other words, are there any regulations in your industry that are going to be a negative factor for you to move forward as a result of either government or some legal authority or something like that? Then the availability of labor. So in other words, if you're a labor-intensive business, is labor readily available? Interest rates. They're going to look at the interest rates, and they're going to take a calculation. They're going to say, if the interest rates go up 3 times, can you cope? And if they find that the interest rates are going to cripple you, in other words, you're just on the borderline. So if interest rates goes up, you're going to, it's like being in water and having your mouth just on the waterline, so you're able to breathe. But if the interest rates rise up too much and your mouth and your nose goes underwater, you're not going to be able to breathe. I'm talking about financially. And so they're going to look at what result an increase in interest rates is going to have on your business. Then if there's any increase in taxation, will that affect your business? Then they're going to look at the business cycle. Is the business cycle in depression, or is it in a boom? So at this present moment, the business cycle in South Africa, and I'd be very surprised if it's not the same in Zambia and the same in Rwanda, is in negativity. So the business cycle is literally heading for a depression. Therefore, your chances of borrowing money are much less because of the interest cycle. Then they're going to look at political unrest. Will this affect the way that you can conduct business? Then in some instances, like in South Africa in the 80s, they're going to look at sanctions. That's the 1980s. Are there any sanctions? And then they're going to look at drought. Why drought? Because if there's drought, particularly if in the farming industry, that's they're going to turn you down. But also if there's drought generally in the country and you are in the food business, then drought may play a big role in it. So food prices will go up. People will start spending their money more on food than on what you're selling. So can the business person meet the challenges posed by the above? And so that's what they're going to look at. So any questions on financial statements in the business environment? I hope you're getting something out of this lecture. Everybody's awfully quiet. I was expecting there to be quite a lot of interest being shown by people, because this is such a big part of how we of our business and how we think of starting up a business. Now, why are loans often, more often than not, turned down? Why? Okay. Number one, the business idea is unsound or is too risky. What are they going to look at there? Your business plan. Insufficient collateral or security provided. So they're going to say you are not putting enough into the business, or you don't have enough for us to act as a security for to cover at least the capital portion of the loan. The lack of financial commitment by the business owner. In other words, you have put very little of your own money into the business. Business plan is badly written or no detailed business plan. That's why I keep drumming on, my dear people, that you've got to go onto the Geo platform. You've got to be finishing off those clocks so that you have a detailed business plan. Now, that's not only to get a loan, but it is to make sure that you've done the thinking behind your business. So why are you going through all of those questions on the Geo platform? What is the purpose? Simply this, so that you have done all the necessary thinking behind what you are planning to do and not leaving things to chance. That's why it's so important that your break-even point is properly corrected and properly written, is complete and makes sense, because that should tell you whether you have a business or not. If you've got to sell too many products, you don't have a business. If you've got to sell few products, you've got a business. So that is why you need to have a detailed and a properly written business plan. The next reason is because the loan is not explained properly or is not acceptable. So you haven't explained exactly why you need the loan and how you're going to use it. Then inconsistencies in the information that is presented. Now, this is one of the key areas where I, as a loan officer for GIG, when I was on their credit committee, in other words, I approved loans. Why I turned loans down? Because there was a lot of inconsistency in the information that was presented. So one of the things that we ask our members to do, and one of the things that loan institutions will ask you to do, is to put together an income and expenditure statement for your own self. In other words, what is your income versus your expenses? And if your expenses, if there's inconsistencies in your calculations or in the information, or it doesn't tie up to your bank account or something like that, then there's inconsistencies in information and the loan is often turned down. Then the second to last one is the character, personality, and stability of the potential borrower. In other words, do you have a good character? Are you squeaky clean, so to speak? In other words, have you paid off other loans that you've got in the past? Are you able to, do you show a good track record? Now, I just want to stop here and just mention this. This to me is absolutely crazy, but it is often a reason why people are turned down. They've never had any credit before. What does that mean? They've never loaned money from any institution before. Now, whereas we might say, that is excellent, well done, my friend. You've managed to get your business going, you've managed to do it all, and you haven't actually borrowed any money. Fantastic. You're showing good results, you're showing good, your balance sheet is good, your income statement is good, your cash flow analysis, your cash flow statements are good. Excellent. But they turn you down. Why? Because crazy thinking in my behalf, in the way I think about it is crazy, but this is what they tell you. They say you've got no track record of taking on credit and paying your credit. So in other words, there's no way that we can check whether you are a good payer of previous debt that you've taken out. So they'd much rather say, no, we turn you down because of that, rather than, and so it's crazy, because if you've got a good track record in terms of the other things in your business, and you haven't needed to borrow money, but you need to borrow money now, why should they turn you down? But that's often the reason. There's no track record in terms of whether you borrowed money and paid it back. So it's kind of crazy. And then every loan institution will have their own individual approach to the client, but the loan institution more than not looks at this relationship as a partnership. They're investing money in your business. They need a return, but they also need to make sure their money is safe and that you are going to grow as a person and they're not recklessly lending you money. I've got one more thing to say, and then we're done with the subject on loans. Now, if you've heard nothing else, hear me now. Be very careful when loaning money from a loan shark. In this country, we call them mashonisa, and they're these people that loan money because A, it is illegal. Why is it illegal? Because they have not been approved by the National Credit Regulator. Most people that loan money in this kind of area, the loan shark mashonisa area, do not want to be regulated by the National Credit Regulator, and they don't care about most of the stuff that I've taught you. They will loan you the money at exorbitant interest rates, and then if you don't pay, they send people after you with cricket bats and with guns and with baseball bats and all sorts of things to rough you up so that you can pay them. And do not, wherever possible, borrow money from these people. And often what happens is you get into what's called a negative debt spiral. So you owe money to this debt, this mashonisa. So you go to another mashonisa to buy money to pay off the first mashonisa, the first loan shark. And then you owe the second loan shark, but you owe them a bigger amount of money than the first loan shark. And then you go to the third loan shark to borrow money to pay off the second loan shark. And so you just get into a worse and worse and worse situation. And I tell you, people have committed suicide over these things. Don't do it. Rather select another business opportunity than get involved in borrowing money from the loan sharks so that you because you got this good business idea. Rather select another business idea. Don't go to the loan sharks. Rather fund it yourself. And if you can't fund it yourself, start a new business. Okay, think of a new business. Now, I know that there are one or two of you, maybe one, maybe two, that are thinking about your business of loaning money. Okay, now, just make sure that you are ethical. Where possible, try to register yourself with the equivalent of the National Credit Register in your country. Or if you can't do that, you've got a moral obligation to not loan money at exorbitant interest rates and to use strong-arm tactics with your customers who don't pay. Then you need to always make sure that you've got some kind of collateral going. So in other words, they are giving you something that secures at least more than 50% of the loan. So that's what I would suggest. Okay, any questions, any comments? Anybody like to ask anything before I do a summary of this lecture?
Morning, Mr. Chris.
Good morning.
It's Maimba.
Yes, Maimba.
My question is, you said that if you go to the to a loaning institution, so maybe it's a bank, and then they tell you that they let you down. They telling you that uh, we don't have any track record of you. What of it's your first time you want to get the loan? And then the second question is, how should you convince them to give you a loan if it's your first time
All right.
without any track record?
Okay. All right. That's a very, very, very good question, Mayimba. Okay. So in this instance, what I would do is I would, look, there's not a quick fix answer. You can't just rectify that in 5 minutes. But what I would do is I would go to a clothing store or something like that that offers credit. I would buy some things on credit, a small amount of things on credit, and then be faithful for the next 3 months in paying that off. And that actually would alter what's called your credit score. In other words, because they would see, here is the person has borrowed some money from somewhere and they have paid it back. So, and remember, they're looking for a minimum of 3 months. So, you're going to have to make credit and borrow, but don't make a huge amount, make a small amount. And then make sure you can repay it over 3 months, and then submit that documentation, and that should get you out of that fix. Does that make sense? Mayimba,
Yes, it does.
all right.
Yes, it does. But in our countries, that doesn't happen, where you can go to a shop and get some stuff, and then they can give you, I don't know if it's a receipt showing that you bought something on credit.
Now, what they're interested in is not that you bought something on credit, is have you been able to repay? Because let's say they give you, 6 months to repay what you bought. Then after 3 months, they'll look and they'll see, oh yeah, no, he's been paying. So let's say you needed to pay, 200 a month or whatever, and you pay 200 for the first month, 200 for the second month, 200 for the third month. Of course, then you need to finish that, because if you don't, then you're going to get a black mark against your name, So that's how you really, it doesn't have to be clothing. It can be anything that is, anything small. Don't go and buy a motor car now or something like that. Something that'll put your, so that they'll rectify that. Look, you'd need to, and I'm really addressing the Zambians and those from Rwanda. You need to check up what exactly of the information that I've given you today applies in Zambia and applies in Rwanda. So in other words, is there something like the National Credit Regulator? What are the rules that banking institutions and other institutions, what are their criteria for loaning money? So, every institution should have a list of criteria. They say this is our tick box, our boxes to tick, basically, to make sure that you've got you meet the minimum requirement of loaning money. So they've got to have that. So go and check that, and then I would actually, in that point, Mayimba, I'd actually go to the bank in question and say, look, I have never loaned any money. What would convince you that I have been a good payer? What would you suggest? And see what they say. So that's another thing. But certainly in Zambia and in Rwanda, go and check out what are the criteria for borrowing money.
Okay, thanks.
All right, any more questions or comments? Hope you found the information presented helpful to you. Anybody? Going once, going twice. Anybody? No. All right, then I'm going to summarize. So I'm summarizing lecture 31 of the Micro Business Starter Program, Funding Your Business, what loan institutions look for when you apply for credit. So the first thing I'm wanting to say is, don't try to do things on your own. Don't borrow money. because if you do, you have to repay it every month. You have to pay off interest, and this can often mess up your cash flow and sink your business. But there are some instances where a loan can help you when you are needing money to set up, money for initial stock, money for working capital, money to expand your business. Then the 5 C's of credit in South Africa, as set out by the National Credit Regulator: your character, the capacity you have of repaying the loan, the collateral, in other words, what are you going to put up as security, capital, how much you need, and the conditions. Are there any conditions that the loan institution would set? And then really what they look at is your financial structure, gearing, current asset management, risks involved, conduct of your bank accounts, and security. And they will also examine your management expertise, the financial structure of the business, the ability to adapt to the economic environment, the sources of repayment, capital contribution by the professionalism of your business plan, and whether you're investing too much or too little. Then they will also look at your financial statements, the environmental factor in which you're going to run the business, and the qualities of your management. And then finally, why some of the main reasons businesses are turned down: the idea is too risky, you haven't put up enough security, there's lack of commitment by you, you don't have a good business plan, your purpose of your loan is not explained and always not acceptable, there's inconsistencies in your information, your own character, there's a blemish in your own character or in your own track record of paying back loans, and every institution has their own individual approach. And finally, I said, be very aware of the loan shark or the Mashinisa. Do not get involved with them. Okay, finally, do it yourself, because if you can self-fund, you are A, going to save yourself money because you're not going to be paying interest, and B, you're not going to be the slave of the person loaning you money.